continue to pay gains from those opening highs, and irrespective of what Asia is doing, or for that matter what SGX Nifty was indicating, our markets are charting our own territory. So now breached the 10,300 mark, and it's a bad breath that you have at your hands. Jet, PC Jewelers, Dish TV, Infibeam, RBL Bank, these are your top price losers within the F&O markets. Gains, or rather losses, of anywhere between about 7.5% on an RBL Bank, which by the way is also seeing some huge amount of OI build up. Remember, it's also expiry week, so almost a 26% OI addition is what RBL has seen, as has Titan. It's seeing an OI gain of about 33%, and the stock is well lower by about 1.25% as we speak. So are we out of the woods yet? Is there more selling to go? Should you buy this decline? What is it that you should do in this market? Jyotivardhan Jaipuria joins in to talk about exactly that. Jyoti, hi, morning. What is your sense of the markets? Do you think large part of the selling is behind us? Do you buy the decline already? What is it that you do as an investor?
We had a market which was expensive. Market has relatively become cheaper than what it was. But even now, valuations are not close to compelling. They are like, probably we are getting somewhere close to what I would say is a fair range, but we probably have another 5-7% downside. My guess is we'll have some price correction and we'll have some time correction, so that probably over the next 6 months we have valuations which become reasonably okay.
Right. Jyoti, how are you mapping earnings and where we go from Q2 onwards, in the light of the fact that we've seen a new reality on the currency, which is much lower than where we were at the end of Q1. Oil prices, again, there's a new base for a normal there, and perhaps into the second half of this year we will be looking at higher cost of borrowing than we've seen in the past. So these three variables, how do you think they would influence earnings for Q3, Q4?
Yeah, so like that whole market, and the reason why it was trading expensive, it was all hinged on that we are at the cusp of a new earnings cycle and we'll have strong earnings over next 3-4 years. It's something which was my view also, and overall I continue to have that view that I think we're still at bottom of the earnings cycle. Over next few years we'll see a strong growth in earnings coming through, but I think near term some of that has got shaken a bit. Not because so much of the currency, because if you think of the currency depreciation actually ironically helps earnings, because a lot of our Nifty or Sensex components, nearly half of the companies there benefit with the currency depreciation. But what is really probably going to hurt earnings over the next 2 quarters is going to be the strain in the NBFCs, because they have been lenders to the consumer sector, and I think that lending will slow down. So because of that, you could see some demand slowdown coming through. Overall, we were looking at earnings growth being in the range of 15% this year. It could probably compress closer to maybe 10 to 12% rather than the 15%. But overall my view is that over the next 2-3 years, I think we can get a compounded 15% earnings growth, and that is what is really going to drive the markets.
Jyoti, so I mean, as an investor, do you think there are opportunities yet in the market wherein the decline has been severe and unprecedented, and you believe that the fundamental story is still intact and one can go out there and start nibbling in perhaps?
Yeah, so in our fund, actually that's what we've been doing. We were sitting on a large amount of cash. We've been buying a bit in the last few days, but yeah, this has been more of a nibbling. We still have a lot of cash and we are waiting for things to come down more. So far, like if you see, a lot of the correction happened because of India factors. It happened mainly because of this whole ILFS crisis, and then the NBFC panic it triggered. But probably what has not happened is really the global correction, because if you see, a lot of the global markets also are trading at very expensive valuations. So the worry is that maybe we have one round of selling globally and then India can't remain totally immune to it. So probably if we get that, we'll get valuations which come down to reasonable levels, because even today if you look at valuations, we are probably trading at like 16.5, 17 times 1 year forward, which is not exactly cheap valuations.
What are you expecting from the consumer names, Jyoti, this quarter around, ahead of the festive season and also into quarter 3?
So, like if we break the consumers into, consumer discretionary has done well over the last, 6 months and the last 1 year. But I think that's where we may see some slowdown because of the NBFC crisis. Because my view is that the NBFCs will slow down dramatically the lending over the next 1 quarter at least. So to that extent, we may see car sales, we may see two-wheeler sales starting to slow down. I like the truck segment there. I think that's something which should continue to do well right up to 2020. The other segment is the consumer staples, which, my problem there is the valuations. I think valuations they are just very, very high, and to that extent, I don't think as an investor we can make a lot of money in that segment. Though probably, they are starting to see some margin pressure because a lot of these oil prices feed into their packaging costs. So it's a sector where there could be margin pressure. The top line is not bad, it's still decent, but for that price, I think, it's just too expensive.
How much of the damage, Jyoti, would you believe for the NBFCs is in the price? And is already time now, you think, to separate the wheat from the chaff? And do you start nibbling into any of the NBFC names, considering how large the umbrella is? And within that, there are so many segments and individual cases, each a different story than the other.
Yeah, it's like a real large segment. So, I would say that over the next 2-3 years, it's not like the NBFCs are going to disappear. They will remain a significant part of the lending pie. But, when we are looking at stocks and we are looking at what to do now, the 3 things we have to remember. One is, the asset liability mismatch will have to be bridged, and probably we'll see some regulations coming from RBI also, which will make it tougher for NBFCs to run a big ALM mismatch. Second is, I think all of them will slow down in the next 6 months. So they'll be forced to slow down, and they'll deliberately want to slow down their book. So the growth premium which was there for these NBFCs will disappear because there won't be a growth. Third is, there's going to be margin pressure for all of them. So, there is over the next 6 months, there is problems. The sector had become very expensive. So that's why even now when, they've corrected quite a bit, it still doesn't look like a cheap sector. It looks like, okay, it's cheaper than what it was a year ago, but it's still not looking cheap. I would say, in this meltdown, probably what we look at is stronger names which are able to, raise money in downturns. That's where one can look at. And second is people who have not run a big ALM mismatch on a historic basis. But actually, if you ask me, over the next 6-8 months, the private sector banks will do better. In fact, I like the corporate banks as well as the retail banks amongst the private sector banks.
Okay. Jyoti, we'll leave it at that. Thanks very much for joining us and sharing with us your thoughts on the markets.
Thanks a lot.